Between 2010 and 2015, the Fed's balance sheet increased from $2.3 trillion to $4.5 trillion. In 2019, and following the COVID, it increased to $9 trillion. And I think following that, it is worth noting that the national debt has increased by 5 times, from $8 trillion to $38 trillion that you talked about, and exceeds 100% of GDP. Last experience after World War II. Also over that time, the CPI index has nearly doubled, with asset prices having risen sometimes as much or more. But looking ahead, which is the important part, gross federal debt will reach $40 trillion this year. The nation's deficit will be $2 trillion this year and for many years to come, as now projected. And the Fed will be expected to help fund this debt. This past fall, for example, the secured overnight financing rate rose above the Fed's target rate of the Fed funds rate, reflecting in part tightening liquidity conditions in the ever larger Treasury market. Not long after that, the Fed restarted, my words, QE, by purchasing automatically $40 billion per month of government securities, about 25% of the average monthly increase of the nation's debt at this time. So stable prices cannot be achieved without fiscal and monetary policy discipline. The history of the Fed's actions has left in its wake, I think, a less independent central bank, a less accountable market, and a less constrained government budgeting process. Thus, it is worth studying the 1951 Accord to guide us for solving the current challenge. So after World War II, like now, the federal debt exceeded 100% of GDP, and Treasury expected the Fed to keep interest rates and the cost of the federal debt low. Inflation was also increasing, however, and the Fed could no longer both suppress interest rates on Treasury debt and control inflation. The conflict between these competing goals was tense, but ultimately a compromise was reached, which confirmed the Fed's right to manage bank reserves and set interest rates independent of Treasury demands. Given current circumstances, the new Treasury-Fed Accord, I think, is needed, as I said. And like then, such an accord does not have to shock the economy. It can be implemented over multiple years, allowing time for the government to reduce its deficits and for the Fed to concentrate on price stability. Reduction in the deficit from its current 6% of GDP would reduce pressures on interest rates, facilitate private investment, and enable the economy to grow out of its current debt dilemma.